Hello, everybody. Welcome to a very special Twitter Spaces today. We have two legends that are going to go over everything about Bitcoin ETFs. We are very happy everyone is here. Thank you to Coinbase for joining us and co hosting with us. We're going to give 1 or 2 more minutes to get everybody else in here, and then I'll pass off the mic to Lee Bratcher, president of the Texas Blockchain Council, who will introduce our two speakers today. So everybody just stand by 1 moment and we'll get this thing started. Alrighty, Lee, I think we have our speakers here. Coinbase is co-hosting with us. I think we're ready to go. Lee, do you want to introduce our speakers and then we'll give them the floor?
Sure thing. Thanks, Mark. Hey, guys. Thanks for being here. We've got people jumping into the spaces, and we'll have probably a lot more when we hit the top of the hour. But I do want to make sure to say a few things about our subject matter experts here before we get rolling, and about Coinbase Institutional and the Digital Asset Council for Financial Professionals. So both entities were partners with us and sponsors at the North American Blockchain Summit, which took place in November. We're grateful for that. Ric Edelman, who founded the Digital Asset Council for Financial Professionals, has, and Mark said this word, legendary is almost underselling it, an incredible career in the registered investment advisor world, has probably the most listened to financial advisor, and certainly around the digital asset ecosystem, was the author of The Truth About Crypto, a book that came out in 2022, and hosts several podcasts on both this topic and just general personal finance. And it's sort of a mouthpiece and sort of a mentor to thousands of RIAs, registered investment advisors across the country. So we're grateful to have Ric on as one of our subject matter experts. We also have Anthony Bassili, who's the head of allocators at Coinbase. Anthony was prior to that, he was the head of pensions at BlackRock iShares, and served as a vice president for business development at BlackRock as well. He holds the CAIRA certification and several other FINRA certifications, such as Series 7, Series 3, and Series 63. Ric, I failed to mention, also hold many of those licenses as well. So at this time, I'm going to probably not do a lot of speaking here. I'm going to turn it over to Anthony and Ric, the subject matter experts, to kind of share their thoughts. And Anthony, you want to open us up?
Sure thing. Can you hear me okay?
We sure can.
Awesome. Thank you, Lee, so much for the invitation. Thank you to the Texas Blockchain Council, and Ric. Glad you're here with us today. And thank you to everybody that's in the room. I wanted to take a quick poll. I don't see how many people are in there, but I can scroll down for a while. So you guys rock. We're glad you're here with us today. So I'm gonna, with Ric, I'm gonna maybe field some questions. For Ric, we're gonna walk through kind of how we got here today, and a little bit about the where really like what's happened today, which is the launch day of this really monumentous event. And then we'll talk maybe a little bit about the market structure of how these ETFs function on crypto. And I know, Ric, we're probably going to go really deep into why this matters, right? Why this matters for advisors, why this matters for investors. So let me start now with Ric for you. Maybe you could give us a little background. Let's go back in time a little bit and let's kind of recap. We're 10 years into this, this thing. We've got a number of ETF issuers, 11 that have launched today. They passed the SEC. It's finally let them through. Maybe take us back to a couple of years ago. What was the conversation like, and kind of how did we get here today?
Well, it's great to be with you, Anthony, and Lee, thanks so much for hosting this event. The fact that there's so many people here demonstrates just how much interest there is in this, and it is a momentous day. This has been a long time coming. As you mentioned, Anthony, this saga began 10 years ago when the Winklevoss twins were the first to submit an application to the SEC for permission to launch a Bitcoin ETF. That was rejected, and dozens of applications subsequent to that over the past decade have all been rejected by the SEC. It got to the point a year ago that the crypto community and the investment community were pretty despondent that the SEC was never going to say yes. And this represented a bias by the SEC. It was clear that they were applying a double standard and a different set of rules to the evaluation of these applications, to the point where Grayscale ended up having to file a lawsuit against the SEC, which Grayscale won, and the court declared the SEC acting arbitrarily and capriciously in its denial of these applications. And that really set the stage for the approvals yesterday and the launch today of these 11 spot Bitcoin ETFs. So it's really very exciting. And the reason that it's so exciting is not merely the launch of the ETFs and great news for the crypto community. This is really a huge victory for the American investor. I've been very deep in the personal finance investment management space for 4 decades, and thank you, Lee, for your very kind introduction of me. One thing you didn't mention, because it's not really something that is forefront for me now, but I created what is now the largest RIA in the country, Edelman Financial, which is managing about $250 billion in assets for 1.3 million households across the country. And over the course of my career, the past 40 years, with a focus on financial education through my radio show and television shows and 13 best-selling books and
Sorry, guys, can you hear me?
Yes, and all of that we have realized that investors need diversification in their portfolios. And investors want the opportunity to take advantage of innovation and new opportunities that come along. And Bitcoin, very clearly, from its invention back in 2009, represents the first new asset class in 170 years. The last time we had a new asset class was the discovery of oil in the 1850s. So look at the impact oil has had on the world. And well, here we are with Bitcoin 170 years later and blockchain technology. And this represents another major leap forward in innovation that is going to be incredible, and I believe one of the great wealth creation opportunities of the century. And yet, at the same time, Bitcoin and crypto in general is different. It isn't similar to anything else we're familiar with. It doesn't have much in common with stocks or bonds or mutual funds or ETFs or real estate or gold or oil. And as a result, crypto has been complicated. It doesn't come second nature to people. You can't buy it in an ordinary brokerage account. You've got to open an account with a crypto exchange. Okay, sorry. Thank you. You've got to open an exchange, account with a crypto exchange. You got to deal with hot and cold wallets and private keys, and it's just complicated. It's complex. It's intimidating, and it has kept a lot of people on the sidelines. And not only that, the Wall Street machine has been unengaged. Financial advisors have been largely prohibited by their firms from participating, which means anyone who's a client of an advisor was not getting help from their advisor in accessing Bitcoin or other digital assets. And this has, I think, limited the ability for most Americans to participate. But now, finally, after 10 years of effort, we now have Bitcoin ETFs on the market. This is revolutionary because ETFs are the most popular investment vehicle in America for all the right reasons. They are very low in cost. They are very low in minimum investment amount. You can get one for $5. The annual fee is incredibly low. Liquidity is very high. They trade throughout the day, just like stocks. They're extremely tax efficient. and you can buy them in any brokerage account where you can integrate them to your diversified portfolio. You can rebalance, dollar cost average, tax loss harvest. You can work with your financial advisor with them. It's very simple and easy to add these to the portfolio, and that's why everybody is so very excited about this. We are going to see this as the beginning of the mainstreaming of crypto into American portfolios, and you're going to see massive engagement by the financial services industry, as is evidenced by some of the sponsors of these ETFs: BlackRock, iShares, Fidelity, Invesco, Franklin Templeton. Some of the biggest players on Wall Street are engaging. It's really very exciting, and so I'm really happy to be here to help spread the word and help you understand how these things work today.
Yeah, Rick, I'm back, and I'll just add a couple things. And if you look behind the ETF, what we know is that 52 million Americans own Bitcoin today. They own crypto. And Coinbase is the custodian and the wallet provider for the vast majority of those. We know that hundreds of millions own crypto around the world as well. So even amidst all of the challenges that you describe on ETFs, 52 million Americans have still figured out how to safely and easily access, what is this new asset class, as you described. So with all those benefits and features, but I think now, importantly, when you think about portfolio construction, especially for the massive wealth segment, right, that's professionally managed, we now have that opportunity to bring professionally managed portfolio construction in a safe, secure, and efficient wrapper, just as we talked about, which I think is critical.
I think you're right. Let me mention one really important thing, because there's a myth out there as a result of the launch of these ETFs, and I just want to dispel this right away, put this to bed. Some folks have been saying, gee, with the advent of these ETFs, is this going to be bad news for Coinbase? Does nobody need to open a Coinbase account anymore? And that's really very much nonsense, for the very simple fact, not only, as you've said, that Coinbase is the dominant provider for people who buy Bitcoin directly as well as other digital assets. But there are two other really important facts. Number one, most of these new ETFs are using Coinbase as their custodian. So instead of them trying to figure out on their own how to do this, they're going to the number one provider, which is Coinbase. Second, let's keep in mind that these ETFs are just Bitcoin. At Coinbase, you have dozens of digital assets that are available to you, allowing you to build a more diversified crypto allocation. So for anybody who thinks that this isn't good news for Coinbase, you're missing the point big time.
Yeah, it's a good point to call out. We support custody for more than 300 assets. We support trading on the exchange for more than 260 different assets. They're all digital assets in crypto. So it's an important point to call out, and it also beckons the question too of, we're starting with Bitcoin. This is a recognition by the institutional marketplace that crypto is here, and that we're going to start with one that most of the market agrees is available for the vast majority, and it has a role in the portfolio, wrapping that under an ETF, as I call it, Web 2 wrapping Web 3. But there's a lot to be done on the back of this, right? As we think about where this goes over time, there are going to be more assets that are going to come out as an ETF to make sure that the market, who generally wouldn't maybe open a custody account with Coinbase, will have access to this in their portfolio, the professionally managed portfolio construction market. So I think those are some critical points. I wanted to maybe sit on for a minute with you, Rick, on some of those elements of diversification that we know about Bitcoin, and its role in the portfolio from a correlation perspective. I'd love to hear your thoughts on it. I've got some thoughts too in terms of what a advisor can think about in terms of when they add Bitcoin to their portfolio,
Sure.
what it does.
There are two basic camps who approach the notion of buying Bitcoin. One camp, which is the one that gets all the press, it's the one you see all the time here on X, and sending social media out all over the place on every platform, all promoting the get-rich-quick notion. They're all talking about how Bitcoin is going to double, triple, quadruple your money overnight, and it's a great wealth generator, and blah, blah, blah. And that's one camp of the marketplace, relatively small camp, but a very vocal camp. That is not the camp that financial advisors sit in. Financial advisors know how to manage money. We've been doing this for a really long time. The average advisor has been in business for over 30 years, managing a lot of money for a lot of clients who are very happy with their investment results of the past 30 years. And advisors focus not merely on return, which is what a lot of consumers think investing is all about. That's only half of what investing is all about. Sure, the return you earn matters, but what equally matters as much is risk. How much risk did you take to get the return you got? And the best illustration of this are lottery tickets. Very high risk, but a very high potential return. And because we know that we're not likely to win, we don't generally put our life savings into them. $1 isn't a bad idea. You might get lucky. It won't hurt you if you lose. That is something we all understand about lottery tickets. Advisors bring the same approach to their portfolio management. We call it MPT, Modern Portfolio Theory. This won the Nobel Prize. Harry Markowitz created this back in the 1950s and won the Nobel Prize in the 1990s. And it is pretty much the standard way that all investment advisors manage money on behalf of their clients. And Modern Portfolio Theory says something really very simple. You want to own a wide variety of investments because the more diversification you put into the portfolio, the lower the overall risks of the portfolio. And what is really fascinating to this is that now that we have 15 years of data on Bitcoin price performance, we now know that Bitcoin is a wonderful portfolio diversifier because its price movements are independent of all other asset classes. It doesn't move in sync with stocks or bonds or gold or oil or foreign securities or commodities or energy. And as a result of this, when you add Bitcoin to a portfolio, you lower the overall risk of the portfolio. And yet at the same time, because Bitcoin has been such a outperforming asset with massive price increases over the last decade and a half, you increase the return. This is the holy grail of investing. You want to have above average returns with below average risks. And this diversification element is the number one reason advisors say that they like Bitcoin in a portfolio. It is a non-correlated asset to other asset classes. And this is what gets advisors so very excited. And here's the best news of all. A little bit goes a long way. In other words, you don't have to have half your money in Bitcoin to get these benefits. A 1 or 2 or 3 or 4 or 5% allocation is plenty. Low single digits is enough for you to optimize the risk-return ratio. And that's exactly how advisors are managing Bitcoin with client portfolios.
Yeah, and Rick, for those listeners who are interested, Coinbase just published, we call it a guide to crypto, came out just a few days ago, and I retweeted it. I'm happy to try to post it in the chat, by our research team. And we basically looked at a lot of this data, updated it for recent price movements. There's a number of things in there that I'll call out. So to your point, Rick, about diversification and what that does on a risk-adjusted basis to overall portfolio returns. If you held Bitcoin from 2018 through 2023, as the data published that report, a 2% allocation to a typical 60-40 portfolio would have boosted total portfolio returns by a little over 100 basis points over that period of time. And with very minimal change to portfolio volatility, and it would have increased what we call a Sharpe ratio, which is your risk-adjusted return, right? The return over volatility that you took. And a 5% allocation, to your point about you don't need very much, would have done obviously a lot better. It would have more than doubled total portfolio performance of that 60-40 portfolio. I know we're a long ways away from true 60-40 allocations these days, but it's a really good indication as to validating why we describe Bitcoin in small amounts as a good diversifier that increases risk-adjusted returns.
And this is something that I think most people aren't recognizing, and they're not therefore taking advantage of it. And that's why I'm really glad you've got that data that you've created, and it's really worth everybody taking a look at that. We too have launched a new investor toolkit. that is available at dacfp.com that gives you a lot of really important information about these different ETFs and helps you compare them simply and easily so that you can decide which of them you like, along with a lot of educational content to help you better understand Bitcoin, crypto, blockchain, and so on. But it's really important that investors understand the risk-reward ratio, because that's what investing is all about. It's not about how much money did you make, it's about how much risk you took to get there. And that is why so many advisors are so excited about this.
Rick, let's go maybe further back in time. When you're thinking about how much risk you take to get there, when at the advent of Bitcoin, it was incredibly hard for someone to access the product. The returns were astronomical. We're at the fourth cycle. We just finished the fourth cycle. Now we're on the fifth cycle for Bitcoin performance. Curious if you have any thoughts on the cyclicality, the cyclical nature of Bitcoin, and how that would change things.
Yeah, it's really fascinating when you look at the price history of Bitcoin. When people take a superficial look at it, all they see is massive volatility. Huge prices go up and then huge price declines. And people argue that that's a reason to stay away. And what they fail to realize is that there's a method to the madness. And it's not unique to Bitcoin. We see this routinely in all emerging investments. In fact, you want to have some fun, punch up on Google a chart of Bitcoin's price history since inception. And just off the top of your head, you know what that looks like, with incredible volatility as Bitcoin was rising to the price it is today, with a 40 or 50 million% cumulative total return, the best performing asset in history. But you know the incredible volatility of Bitcoin the past 15 years. Now do this. Google Amazon's price history for its first 15 years. And those two charts are virtually identical. There were a lot of occasions where Amazon's price almost fell to zero. Many times in Amazon's early years when the company almost went out of business. And it took a lot of guts to invest in Amazon in the 1990s, and not very many people did it. Today, everybody owns Amazon. If you have a stock ETF, there's Amazon inside it. And it's a no-brainer to own Amazon. But it took a lot of guts back in the 90s. That's similar to Bitcoin. It took a lot of guts to buy Bitcoin 10 years ago. Today, it's on the verge of becoming a no-brainer. And 5 years from now, it'll be as ubiquitous in diversified portfolios as Amazon is today. So this is because of these waves that Anthony is referring to, that it reflects the development, the evolution, the maturization of an emerging technology. Nobody in the beginning is exactly quite sure what it is or what to make of it, and so it ebbs and flows with attitude and sentiment. And then it reaches a milestone, it hits a good plateau, that becomes a new baseline, and then there's another wave of a similar nature. And as Anthony has said, this has happened 4 times now in Bitcoin, and a lot of this has to do with the coinciding of the every 4-year Bitcoin halvings, where the number of new Bitcoins that gets released into the marketplace gets cut in half on a set schedule roughly every 4 years. That next cycle comes up at the end of April. So this really demonstrates that we are going through an experience with Bitcoin that is not new, it's not unique, and that means it's not surprising. And those who understand this and understand how to capitalize on it can really benefit, as opposed to those who are going to wait another 5 years or 10 years when it becomes as obvious an investment as Amazon is today.
Yeah, and throwing some numbers on the volatility, Rick. So back in 2020 and even periods before that, you would see Bitcoin and other crypto assets hit annualized volatility numbers of more than 100%, right? Which means they're incredibly volatile, which is, to your point, not too different than emerging technology stocks. Mm-hmm. But over the years, we've seen the volatility as the institutionalization. So the more institutional users who have come in to trade on this on Bitcoin as an asset for macro hedging reasons, for price performance reasons, you name it, the volatility has fallen. So more recently, over the last maybe 2 years, the volatility has fallen from 100% down to around 40, and so it's trading range bound lately in between 40 to 60% annualized vol, putting it below a lot of your emerging technology stocks in your equity portfolio. So when you couple that with the fact that it's also uncorrelated, so the correlation of Bitcoin on 3-month rolling correlation more recently has been around 0.18 to the S&P 500, and even lower to bonds, about 0.1, and negative to the VIX. Right. So to your point earlier, you mentioned this as being uncorrelated to other parts of your portfolio. So great diversifier, good use cases in there.
And there's a really important underlying message in all that data as well that's worth highlighting. It all, because of, historically you mentioned a 100% volatility in a given year. This really puts an exclamation
This space was downloaded via spacesdown.com. Visit to download your spaces today.
point on the importance of not trying to engage in market timing, because odds are really good. You're going to buy high and sell low, and you're going to miss the returns that Bitcoin itself is generating in your efforts to catch it right. So it's a reminder that when you're going to engage in an emerging, developing new asset class like this, that you have a long-term focus and aren't trying to get rich quick overnight.
So how do we shift, Rick, into, that's a good point, because, and that's why people hire advisors a lot of times, right? It's to get access to great products and to get professional guidance, so you're not emotional about your trading. What are you hearing from advisors these days in terms of their ability to have conversations with clients about Bitcoin and digital assets?
Well, this is day one of the availability of these new spot Bitcoin ETFs. So I'm going to give you where we were prior to today, because today is the top of the pyramid. We were on one side of the pyramid and we're about to cross over to the other side of the pyramid. So let me give you what it's been like. Historically, meaning up until today, the overwhelming majority of financial advisors have been prohibited from engaging with their clients in conversations about Bitcoin. Not only were they unable to help their client buy it, in many cases they weren't even allowed to help their client talk about it, because their compliance departments didn't give them permission to do it. And the reason is because there was no available ETF in the marketplace, and the SEC has not issued clarifying regulations that gave these compliance departments confidence. And the result was that if a client called the advisor and said, I have questions about crypto, the advisor's attitude was, sorry, can't help you. Now, sometimes it was because the compliance department told them they weren't allowed, but equally often the advisor couldn't help because the advisor themselves didn't know anything about this. This is why I created DAC-FP back in 2015, now 8 years ago, because we realized that there was no education opportunity for financial advisors. And at DAC-FP, our goal is crypto education, both for advisors and investors, because there was no such outlet. And we remain today the only independent outlet for that education in the marketplace. And so what we found is that historically, meaning up until today, investors were on their own. They had no choice but to go about this any which way they could. And this is why we have seen so much fraud and abuse in the crypto world, because people who don't know what they're doing, who are dealing with an asset class they are totally unfamiliar with, go searching and surfing on the web and come upon somebody who looks legit, sounds legit, acts legit, and turns out to be a con artist or an outright fraud. And this is why the FBI says last year $2 billion was lost to crypto frauds in the US. This is because professional financial advisors were not engaged, because advisors know how to protect their clients against frauds. They know how to identify them and deter the client away from them. I'll give you one quick anecdote. This just happened last week, and it's so tragically ironic that it happened last week on the eve of these new ETFs. An advisor called to tell me, to ask my help to assist their client. And here's the quick story. Their client called them on the phone 6 months ago and said, I would like to buy Bitcoin. And the advisor said, sorry, I can't help you. So the client said, fine, I'll go figure it out myself. The client went on the web, searched, found a firm that looked pretty legit, really strong, great website, sent this firm $1 million. Last week, the client calls the advisor and says, I need you to send me 300 grand. The advisor said, why? And the client said, because I bought Bitcoin 6 months ago from this firm I found on the web. The account has done so well, it's made so much money, they told me I now have to pay the taxes. In order for me to liquidate the account, I have to prepay the tax to get my money, which is, of course, a scam. There is no such taxing agency that requires you to pay taxes before you can liquidate your account. And the client, who lost $1 million without knowing it, was about to lose another 300 grand. At that point, the advisor was able to step in, tell them they were being scammed, and save the 300 grand, but wasn't able to protect the client from losing $1 million. Had that advisor had permission from their firm 6 months ago to provide crypto to the client, none of that would have occurred. And this is a horribly tragic story that has been occurring throughout the country over the past decade because the financial services industry has not been engaged in crypto, forcing investors to do it on their own when they really don't know how to do it. So that is where we were. Today, the world is different because today, for the very first time, we have Bitcoin ETFs, which allow advisors to engage. All of these ETFs, all 11 of them, are available on Schwab's platform. If you're an individual investor working as retail directly with Schwab, you can buy them as you wish. If you're an investment advisor who clears through Schwab, and they're the #1 custody firm for advisors in the nation, if you're a client working with one of those advisors, you have access to all 11 of these Bitcoin ETFs right now. This allows, for the very first time, instantly today, access of these ETFs via advisors. Advisors can now engage on behalf of their clients. We're going to see a radical reduction in fraud as a result of this, and it's great news. So we're going to see a big sea change, Anthony, going forward. We're now on the other side of that mountain, as advisors are now able to say, I've been to the top, I can see the horizon, and we're now able to play and engage and benefit our clients. And oh, by the way, the advisors will benefit as well, because by serving the client, they'll get more clients, they'll get more assets under management, their revenues will go up, everybody wins.
There's so many good things that are going to happen from this. I'm curious, Rick, when you think about the rollout, because your point is great, which is Schwab has all 11. There were a number of platforms that listed, a number of different products, Fidelity and others. But it takes time for the asset itself to kind of percolate into the national account structure and the wirehouses and others. Right. Maybe give us a little bit of a insider's view on the timeline for kind of full rollout when the entire wealth industry will have access to Bitcoin.
Yeah, there are 3 categories within the financial industry. You have wirehouses. Those are the big national brokerage firms. Think Merrill Lynch, UBS, Morgan Stanley, Goldman Sachs, JP Morgan, the big wirehouses. Then you've got IBDs, independent broker-dealers. These are the regional firms, Raymond James, Edward Jones, A.G. Edwards, LPL, Commonwealth. These are smaller organizations, but not necessarily tiny. LPL has 15,000 advisors, so we're not talking tiny by any stretch, but they aren't necessarily household names. And then third are the RIAs, the independent registered investment advisors. This is where my firm sits. The RIAs are independent, meaning the advisors here are self-employed, they operate their own business, and they clear their securities transactions through a custodian. The big 3 are Schwab, Fidelity, and Pershing. The independent RIAs are the most agile, because these are self-employed people. They can do whatever they want. They are, as a business owner, I am my own compliance officer. I am my own investment committee. So I don't need to ask anybody's permission. I don't have a bureaucracy to go through. I can do what I want whenever I want to. As long as I'm conforming to securities laws, serving the client's best interest, we're good. And so these advisors can begin today allocating to client accounts, and many of them are already begun to do so. The middle group, the IBDs, the regional broker-dealers, they're a little slower to respond. They have to figure out which of these ETFs they want to make available to their onto their platforms. And then third are the wirehouses. They are the slowest. They typically won't allow an asset onto its platform until it has 100 million in assets, until it has a year's track record or more. They are dealing with so much money and so many advisors, hundreds of thousands of them, and so many trillions in assets. They want to make sure these ETFs have sufficient liquidity, they can handle the trading volume, and so on. So most of Wall Street is going to move slowly. The independent advisors, which is a relatively small subsection, they can move faster, but there's not as many of them. Collectively, they're a powerhouse. $8 trillion collectively in the RIA channel, but still it's relatively small compared to the wirehouses. So you'll see movement slowly at first, and then it'll pick up. But let me add one other element to this. Even in the RIA channel, where they have the ability to act immediately today if they wanted to, most aren't going to. And this isn't because they don't like Bitcoin. It's simply the realities of operating your practice. If you're an advisor running your own shop, here we are at the beginning of the year. You just finished tax season, 12/31. You're getting ready for tax season coming up. The 1099s and the K1s are going to be coming in the next couple of weeks. You're focused on those elements. And now we have these new ETFs. Most advisors don't know much about crypto. They're going to have to get themselves up to speed. They're going to have to learn how this works. Many of them are going to take our course and get their CBDA designation, certified in blockchain and digital assets, a professional designation listed by FINRA. Many will go through the program to get the knowledge they need. Then they're going to have to decide which of these ETFs do they want to recommend to clients. Which of their clients are they going to want to recommend it to? And how much of an allocation are they going to recommend? And after they figure all that out, they then have to communicate with their clients and talk to them about it and let them know what they're planning to do. Then they've got to have their team do the trades and execution. All of this is going to take some time, and months, frankly. It's not going to be a light switch overnight. So the asset flows into these ETFs are going to come. I believe we're going to see $150 billion in flows over the next 2 years. But it's not going to happen over the next 2 weeks. So people need to be patient. Anybody who thinks that there's going to be an immediate flood of assets like a fire hose, that ain't going to happen. But it will eventually come. And we just need to understand the logistic nature of operating an advisory practice and why this is all going to take a little bit of time.
Hey, Rick and Anthony, I'll jump in with a question here. There was some news that broke today about Vanguard and I think Bank of America as well, that they weren't going to offer this to their private wealth clients. What's y'all's take on that? And perhaps you've probably done some more reading on what they actually were making in that statement.
There's nothing new here. First of all, Bank of America is a bank. They own Merrill Lynch. Remember, I just mentioned a moment ago that Merrill, along with the other major wirehouses, are not going to offer this right away. You've got to go through their due diligence process. They've got to get their compliance approval. They've got to establish their investment committee guidelines. They then need to train their advisors. This is going to take them time, and they are in no real hurry to move. So they will be the last mover. That's not at all a surprise, but they will engage. In fact, my prediction is eventually Merrill Lynch will offer its own spot Bitcoin ETFs. Merrill already has a lot of proprietary product. They're going to add this to their stable so that they can collect the management fee instead of letting somebody else have it. As for Vanguard, this is a very different story. Vanguard has always hated crypto. Vanguard said years ago that they were not going to allow their customers to buy grayscale products on their platform. And today they persisted in their viewpoint that they're not going to allow these ETFs to be used by their customers. This is a puritanical and very limiting point of view. It is parochial. It is a viewpoint where Vanguard says, we think this asset is too risky and we aren't therefore going to let our clients buy it. That's an absurd position. This is none of their business. Their job is to facilitate the ability of their clients to purchase the investments their clients want to buy. If this is a listed security approved by the SEC, it is none of Vanguard's business to decide whether or not the client should be able to buy it. And I believe as a result of this, in the long run, one of two things is going to happen. Either Vanguard is going to change their mind and permit the availability of these products on their platform, or they're going to lose clients and assets as those clients recognize that they can't get something they want and they're going to go to Schwab where they can. So I think it's a very bad business decision. I think it's a misguided sentiment that puts Vanguard in a role of being smarter than their own customers. And I think it's unconscionable. And I don't think it serves the customer's best interests in any way.
Yeah, I think I'll just comment. I think, Rick, your point's right, which is it's going to take the bigger infrastructure platforms, the banks and stuff, longer, just from an approval perspective. For the likes of Vanguard and others, it's a shame because we have to remember, the use case is not just price go up, right? The use case is portfolio construction, risk management, and asset allocation across a diversified pool of assets. And so if I am an advisor and I have to construct my portfolio with a number of different asset classes, and one of those I want to be Bitcoin, I now have to use a different platform, right? So naturally, that's just complex, and it creates risk for me as an advisor because it causes performance differentials in what I give to my clients, and it just makes operations more complex. So, as a low-cost leader, you would think today, over the last few days, we saw the fees on these products, kind of rapidly fall, and I think we settle on a floor, hopefully, of around 20 bips, which is great, which is a good place to be. It's good for the consumers, and it goes up from there. But we do think the fees will continue potentially to drop over time as the product gains more traction across the space. But if a large platform like Vanguard and others are choosing not to participate, they're going to miss out on a really important part, in addition, of an asset class. And I want to go back to that. Right, this is an asset class. The Web3 economy, right, is going to be a real part of your portfolio. It starts with Bitcoin, and it's going to extend into other assets that are digital that you hold in this category. And people need to understand that there's going to be a carve out here that they have to account for.
And the most sad part about this whole thing is that Vanguard is simply wrong. I mean, I get it when a pharmacy announces, and CVS made this announcement a couple of years ago. CVS announced they are no longer going to sell cigarettes. That made perfect sense. This is a pharmacy, a healthcare company, and cigarettes, let's face it, are bad for you. Made perfect sense for them to announce you can't buy that product here. But for Vanguard to say, as a distributor provider of investments, that you can't buy that investment here because it's bad for you is simply factually incorrect. The allocation makes perfect sense for a diversified long-term portfolio when you use it properly. And the fact that Vanguard could reach this decision, I just question their motivation. I question their thinking. I wonder if there's a different agenda built in. It's not lost on me on the fact that Vanguard recognizes the political nature of this decision, that there are many Democrats who have been strongly opposed to crypto, and I'm wondering if they're trying to play a political game as opposed to an economic one or an investment one or a business one. So I just wonder what's going on behind the scenes that they haven't talked about that has contributed to this decision of theirs.
Yeah, and think about what's coming up. We have the halving, Rick, that you mentioned. The halving's coming up this year. We have the end of a macro cycle. So we have rates turning over, potentially longer term rates now look like they're going to end in like the 3.5% range. At the end of this next rate reduction cycle, and we have plenty of political uncertainty, and we have a lot of geopolitical risks around the world. Right? All of these are components that are going to impact portfolio allocations and portfolio returns. And if you're excluding this diversifier that trades 24/7, 365, and allows investors to respond to these mega events over the weekend, for example, in the true crypto cycle, that's a big deal for portfolio construction. This is a fundamental shift in the way institutions manage risk, right? And it's going to show up in the ETF, right? It's going to show up in price performance and the way that this product trades. So it's really important for folks to understand that this is a truly novel product that has a lot of features that you're not going to find in anywhere else in your portfolio.
I think that's a really valid point, and it's the one word that just keeps popping into my head through all of this is education. People are often unfamiliar with how crypto works. They're unfamiliar with blockchain technology. They're unfamiliar with the differences between Bitcoin and Ethereum. They're not necessarily all that familiar with ETFs and the investment management world. And yet there's already so much news about this. There's such a focus because it's the biggest news in the investment world this year, and it's the biggest news in crypto in 10 years, that there's a lot of attention. And it's even going to grow because you've got 11 companies all launching on the same day. It's literally as a horse race. The starting gate opened, and they're off and running. And they are all anxiously in a hurry to generate assets under management. They all want you to invest with them as opposed to the other 10. And that means they're going to be engaging in massive marketing and advertising campaigns. Some of them are already doing it. And that means you're going to be seeing this, hearing this, reading about this all over the place in social media platforms, on Bloomberg and CNBC. I wouldn't be surprised if there wasn't a Super Bowl ad from one of these companies. So it's going to be out there, and that's going to entice investors to ask the fundamental question, should I invest? And if so, into which one and how much? And we really need to take a step back and focus on education. Let's make sure you understand what these things are and how they work so that you can be sure you're putting them to best effect for your own circumstances.
So Rick, maybe the final thoughts here. How do people? You mentioned the credentialing association that you created. Maybe how do people follow that and pay more attention to the education that you're talking about?
Yeah, we created 3 years ago the CBDA, the Certified in Blockchain and Digital Assets designation. I mentioned it's now listed by FINRA as a professional designation alongside the CFP and CLU and CPA and all that kind of good stuff. And it's an online course. There are 5 different tracks. We have a track for investors. We have another track for advisors. And we have another track for home office personnel, the compliance officers, investment committee, and so on. We also have an ex-US track for professionals who live and work outside the United States. And we now have had thousands of people go through our course from 37 countries. It's the oldest and largest designation of its kind in the crypto field. It's an online course, self-study, self-paced. And if you're an advisor, you can get as many as 18 CE credits. Plus, you get the right to use the CBDA designation to demonstrate to your clients that you have attained this level of knowledge and competency. You can learn all about this at our website, dacfp.com, dacfp.com. In addition to our credential, we offer lots of webinars. We have several coming up this week and next week on the new ETFs and due diligence for crypto. We have a lot of content on our website, audios, videos, printed material. We just introduced, as I mentioned, the Advisor Toolkit and the Investor Toolkit. Both of them are free. You get them at dacfp.com so that you can easily get a nice little chart that compares all of these 11 ETFs across 16 subject categories, so you can easily compare the differences. We have a one-page infographic. We have a lot of other educational videos and materials to help you learn about all this. We're also doing on my daily podcast a series of interviews with the ETF providers. The first one aired today. The second one is tomorrow. We're doing them all through next week. If you missed any of them, you can listen to the replay at my website. We're also hosting a series of webinars, as I said. All that content and info is available at dacfp.com. plus live conferences. We have a couple of events coming up in Austin this year and in Miami. So a lot of different things we do to help increase the level of knowledge of both investors and advisors, and all of it at dacfp.com.
That's awesome. And of course, folks can go to coinbase.com and find our research page. We publish a weekly, a monthly, and quarterly market outlooks and deep dives on the macro cycle and how Bitcoin plays a role in that. Go check out the crypto guide that we released. It talks about Bitcoin ETH and a lot of the, for the traders out there, there's some really good data. And yeah, I would just say Coinbase, we're incredibly proud of this moment. It's been a long time coming for us as a firm. We're glad to be the custodian for 8 of the 11 products. And we're really excited to work with you, Rick, on making sure that people get the education they need. So thank you so much for doing this with us.
It's my pleasure, Anthony. Thank you. I've been long associated with the Coinbase for many, many years. I think Coinbase was the first crypto exchange I opened an account with way back in 2012. And so I can certainly attest to the quality of this firm. And we all know the prominence that Coinbase has created for itself over the past decade and a half, and rightly so. And so I think it is a good demonstration of how crypto is maturing and evolving. We now have professional management, adults in the room. That was a far cry from the way it was back in the day. And I think that really has been a big reason behind this catalyst. The fact that 8 of the 11 ETFs are choosing Coinbase as their custodian kind of speaks volumes. So I'm really glad to be working with Coinbase, which we do periodically, and with educational activities like this one, and happy to do it. Always good to be with you, Anthony.
Awesome, guys. Well, we are very grateful that you would spend your time and share your expertise with us and with the audience here. And with that, we will wrap things up and schedule other educational spaces like this in the coming weeks. So appreciate it, guys. Thanks for jumping on. And Anthony, Rick, feel free to make any parting comments.
My comment would simply be that this is going to be the opportunity for a lot of people to get engaged in crypto for the very first time in a completely convenient and easy way. And I think this is going to be the beginning of a journey for a lot of folks down the crypto rabbit hole. And I think it's really exciting.
Yeah, I'll just echo. I just want to say thank you, everybody, for being here with us. And we really